Welcome to MoneyScopeTV, where we make investing simple. Today we're demystifying the stock market. No jargon, no intimidation. The stock market isn't just for the wealthy, it's a tool anyone can use to build wealth over time. Forget the Hollywood drama. Investing is about patience, not luck. We'll break down what the stock market is, why it matters, and how you can get started. By the end, you'll understand the basics and feel ready to take your first step. Investing is accessible, digital, and designed for everyone, including you. Let's start your journey to financial confidence. What is the stock market really? It's not a casino or a secret club. At its core, it's a marketplace where you buy and sell pieces of real companies. When you buy a stock, you become a part owner, sharing in the company's future. Companies use the market to raise money for growth. Investors use it to grow their wealth. The market isn't about overnight riches or disaster. It's about steady, long-term growth. The dramatic headlines are just noise. The real story is about building wealth over time. The stock market connects businesses needing capital with people wanting to invest. We'll show you how this system works, so you can use it to your advantage. Let's make the market work for you, not against you. The stock market is a giant digital marketplace for buying and selling shares. A stock is a small piece of ownership in a company. When you buy one, you own part of that business. Your interests align with the company's success. If it grows, your investment grows. Companies sell shares to raise money for expansion, innovation, and hiring. Investors buy shares to put their money to work and potentially earn more than a savings account. You're not just a consumer, you're an active participant in the economy. Every transaction connects people's savings with business ambitions. Whether it's Apple or Coca-Cola, the principle is the same. You're betting on a company's future. This is the foundation of investing: simple, powerful, and open to all. Not every business is on the stock market. Most start out private. To go public, a company launches an IPO, selling shares to raise money for growth. Investment banks help set the price and handle regulations, ensuring transparency for investors. Once public, anyone can buy shares through a stock exchange. The company gets cash to expand, and new shareholders get a stake in its future. After the IPO, shares are traded between investors on the secondary market. When you buy a stock, you're usually buying from another investor, not the company. The stock exchange matches buyers and sellers instantly. This process turns private businesses into public opportunities for everyone. The stock market is a global network of exchanges, not just one place. Each exchange lists different companies and has its own rules and hours. The NYSE and NASDAQ are America's biggest, home to giants like Apple and Coca-Cola. Other major exchanges include London, Tokyo, and Hong Kong, making investing worldwide. These exchanges keep markets active around the clock, connecting investors everywhere. You don't need to know every detail. Your brokerage gives you access to the world's top markets. The key is that investing is now global and accessible from your phone or computer. No matter where you are, you can invest in companies across the globe. The stock market is your gateway to worldwide opportunities. Stock prices are driven by supply and demand. Supply is the number of shares available. Demand is the number investors want to buy. Their interaction moves a stock's price. Positive news increases demand, raising the price. Negative news increases supply, lowering it. This constant push and pull creates price fluctuations. A stock's price is the latest agreed upon trade. Understanding supply and demand demystifies stock price movement. While supply and demand explains price changes, it doesn't explain why demand for a stock might increase or decrease. The primary driver is the company's performance, combined with investor expectations. A stock represents ownership in a business, so its long-term value depends on how well that business is doing. A company consistently growing sales and profits is more attractive to investors. Quarterly earnings reports are important, giving investors a look at the company's health. Better than expected earnings often lead to increased demand and a higher stock price. Stock prices are forward-looking. You're betting on future success. Even good current profits might not prevent investors from selling if future expectations are low. Ultimately, a stock's price reflects the market's judgment about a company's future earning power. Beyond individual companies, broader economic factors significantly influence the stock market. Economic news like inflation and unemployment rates are closely watched. Interest rates, set by central banks, are a powerful lever. Human emotion, though unpredictable, is a potent market force. Optimism during bull markets and fear during downturns can drive prices, sometimes irrationally. Understanding this helps investors remain level-headed. Just as there are many different types of cars, the stock market is filled with different types of stocks. Let's explore 4 common classifications you'll encounter: blue chip, growth, dividend, and penny stocks. Blue chip stocks are shares of large, well-established companies with a history of reliable performance. Growth stocks are shares in companies expected to grow faster than the market. Dividend stocks distribute profits to shareholders as regular cash payments. Lastly, penny stocks are ultra-low-priced shares of small companies but are extremely risky. Picking stocks requires research and carries risk. For beginners, a powerful alternative exists: the exchange-traded fund, or ETF. A single share of an ETF gives you ownership in a basket of different stocks or assets. This built-in diversification is a major advantage. For example, instead of picking individual tech stocks, you could buy a technology ETF. You can buy an S&P 500 ETF and own a tiny piece of those companies. ETFs are popular due to their simplicity, low cost, and transparency. This allows you to build a diversified portfolio with just a few ETFs. Beyond the broad categories of blue chip, growth, and dividend stocks, investors also classify stocks based on 2 other important criteria: the industry in which the company operates and its overall size, which is measured by market capitalization. Grouping stocks by industry helps investors understand the specific economic forces and allows them to build a diversified portfolio across different sectors. Common industry sectors include technology, healthcare, financials, consumer discretionary, which covers non-essential goods like cars and vacations, consumer staples for essentials like food and soap, and energy, among others. Spreading your investments across these different sectors is a key diversification strategy. This sector-based approach is crucial because different industries perform differently depending on economic climate. For example, during an economic recession, consumer staples companies tend to be very resilient because people still need to buy food and household products. In contrast, consumer discretionary companies might struggle. By holding stocks in various sectors, you can protect your portfolio from downturns that disproportionately affect one single industry. Even if one part of your portfolio is struggling, another part may be thriving, creating a smoother investment experience over time. The other critical classification is market capitalization, often shortened to market cap. This tells you the total market value of a company's outstanding shares. You calculate it by multiplying the stock price by the total number of shares. Companies are sorted into 3 main tiers: large cap, mid cap, and small cap. Large cap companies are the giants of the market, typically with market caps over $10 billion. This includes blue chip stocks like Apple and Walmart. They are generally more stable and less risky investments. Mid-cap companies with market caps between $2 and $10 billion are the middle ground with more growth potential than large caps. Small-cap companies with market caps below $2 billion are smaller, younger businesses with significant growth potential but higher risk. Many investors build a portfolio that includes a mix of all 3 sizes. By understanding these classifications by type, by industry, and by market cap, you can look at the stock market with a more strategic eye, ready to build a portfolio that fits your goals. Now, how do you actually buy your first stock or ETF? The fantastic news is that in today's digital world, this process has become incredibly simple and accessible. The single most important tool you need is a brokerage account, which serves as your personal gateway to the financial markets. A brokerage account is simply a specialized account designed to hold your investments. It can hold stocks, ETFs, and other financial assets. Opening one is the essential first step, and it's a process you can complete online in just a few minutes. There are numerous online brokerage firms to choose from, each with its own platform, features, and fee structures. The process of opening an account is very similar to signing up for a new bank account or any other online service. Once your account is approved, you will have your very own investment account, ready to be funded. This is your personal portal to the world of investing. With your brokerage account ready, fund it. Connecting your bank is secure and easy. You don't need much to start. Many platforms have no minimum deposit. Start small to learn and build good habits without the stress. Once funded, you're ready to invest. A broad market ETF is a wise first step. Search for its ticker symbol, like VOO or SPY, then place a buy order. With fractional shares, you can invest any dollar amount, making even expensive stocks accessible. Confirm, and you're officially an investor. Now that you know the mechanics of buying a stock, it's crucial to discuss the mindset that separates successful long-term investors from gamblers. The single most important rule is to do your own research before you ever click the buy button. While it can be tempting to jump on a stock that everyone is talking about on social media, or that you heard about from a friend, this is a dangerous and often costly strategy. Hype-driven investing is based on emotion and speculation, not on a solid understanding of the underlying business. A smart investor takes the time to understand what they are actually buying and why they believe it will be a good investment for the future. If you are considering an individual stock, start by understanding the company's business. Before buying an ETF, you should look at what it actually holds. By cultivating a mindset of patience, curiosity, and research from the very beginning, you are building a foundation for sustainable long-term wealth creation. The stock market offers the potential for significant financial rewards over time. Historically, the broad stock market has delivered average annual returns. The real magic behind this growth is compound returns. Compounding happens when your returns themselves start earning their own returns. Time is your greatest asset as a young investor. It's about letting your money work for you, building a secure financial foundation. A patient, long-term and diversified approach to investing helps in achieving financial independence. Investing has risks. Market values can decline, company-specific issues can also cause losses. Emotional reactions can hurt your portfolio. Mitigate risks through diversification, a long-term view, and patience. Prepare and stay on course toward your goals. As we bring our guide to a close, let's distill everything we have learned into a few simple, practical, and actionable tips that you can use as your blueprint for getting started in the stock market. Think of these as your core principles, a set of golden rules to keep you grounded and focused as you embark on this exciting new journey. The world of investing can seem noisy and chaotic, filled with conflicting advice and daily drama. These fundamental tips will help you cut through that noise, build a solid foundation, and cultivate the habits that lead to long-term success, ensuring you start your investment journey on the right foot with clarity and confidence. First and foremost, start with broad market ETFs instead of trying to pick individual stocks. While the idea of finding the next big thing is alluring, it is also incredibly difficult and risky, even for seasoned professionals. By starting with an ETF that tracks a major index like the S&P 500, you instantly achieve diversification across hundreds of established companies. This single decision dramatically reduces your risk, protects you from the failure of any one company, and allows your investment to grow in line with the overall economy. It is the simplest, most effective, and most recommended strategy for beginners to build a core portfolio with a sensible, risk-managed approach. Second, make investing a regular automatic habit. This strategy is known as dollar-cost averaging, and it is incredibly powerful. Instead of trying to time the market by guessing the perfect moment to buy, you simply invest a fixed amount of money on a regular schedule, such as every month or every payday, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same fixed amount buys more shares. Over time, this approach smooths out your average purchase price and removes emotion from the decision-making process, turning market volatility into an advantage rather than a source of stress. Finally, and perhaps most importantly, keep your emotions in check and commit to a long-term perspective. Do not panic when prices fall, as market downturns are a normal and inevitable part of investing. Do not get swept up in the hype surrounding get-rich-quick stocks you see on social media. Remember that true investing is not gambling. It is the slow and steady process of building wealth over years and decades. Continue to learn, stay curious, and trust in your long-term plan. By following these simple tips, you are not just buying stocks, you are building a disciplined and intelligent financial future for yourself. We've covered a lot, from the basics of the stock market to how you can become an investor. Our goal has been to demystify investing, showing it's open to everyone, regardless of background or starting capital. It's a way for ordinary people to build long-term wealth. Investing is a journey, a marathon, requiring patience and continuous learning. Your financial education is just beginning. Taking control of your finances is self-care, giving your future self financial security. Start small, stay consistent, and invest in your financial literacy. Your journey has begun.